Hey folks, Casey Dimon here, TaxLawAcademy.com. I have a lot of beginning investors ask me, should they purchase tax liens or tax deeds? Well, my answer depends primarily on their investment objectives. First off, the difference between a tax lien and a tax deed must be discussed. A tax deed is an instrument that transfers the ownership of a parcel of real estate to a buyer due to delinquent property taxes, whereas a tax lien is a priority lien against a parcel of real estate due to delinquent taxes. Now, a lien is going to be purchased by a tax lien investor in an effort to earn interest on their investment, which is backed by the underlying asset, which is that property. Now, tax lien, you're buying a lien, tax deed, you're buying property. So which one should you choose? Well, with a tax deed, you're purchasing the property. You have control over that property. You have the ability to sell or to hold on that property. You have a lot of control with tax deeds. Tax deeds will generally allow for a much larger profit, but it will also come with added work since you must sell a piece of property in order to realize your profit. To get to that point, you will certainly have a few hurdles as you would with selling any real estate. Property maintenance issues can be a major one to consider, for example. And of course, you are the one required to handle the sale. This can mean title work, marketing, dealing with buyers, all sorts of that fun stuff. When it comes to tax liens, they will generally provide a smaller return on your money, but will also require less ongoing work. The majority of your work is going to be put in ahead of time with tax liens. Your lien is secured by the underlying real estate that's tied to that lien, which means you must understand everything possible to ensure that the real estate has at least the same value or higher than the lien that you'll be purchasing. You must also be certain that your purchase price leaves you room for a return and that your budget is used strategically. While you might be able to have a little bit looser budget for tax deed property, since you can make it up when you sell that property in the long run, you don't know when you will realize your investment on a tax lien. It could be returned to you in a month or 2 months or even 2 years, and the redemption date, which you have no control over, is what your return is based on. And if it's redeemed very, very quickly in the first month or two, your return can be very, very small and your margins might be very small. Of course, if the lien is never redeemed, you could acquire title of the property, but this is very rare, so your primary focus needs to be on the interest that's going to be paid to you, since that's how you'll realize your investment for a tax lien. Now, once your investment is made, it is truly a waiting game for tax liens. There is no further work involved on your part unless the redemption period expires. Liens do not require the ongoing effort, the ongoing maintenance, the ongoing selling that tax deeds do. In summary, tax deeds will provide more of a cash windfall and will require more of an effort to realize that profit, whereas tax liens will provide a steady return that isn't nearly as high as tax deeds, but without the time and possibly the capital that's required in order to realize those returns. Now, obviously, this really generalizes the process, and it does vary greatly depending on the state's laws, on the specific property, and a lot of other factors, but this does give you an idea of the recommendation that I make to some of my students. Now, the most successful tax investors do have a variety of liens and deeds, and the percentage of each that they have will depend on their personal investment objectives, but it's very common to see investors mix the two. To learn more about tax law investing, head on over to TaxLawAcademy.com and browse all the content that we have on the website. Again, the website is TaxLawAcademy.com. Have a wonderful day, folks. Bye-bye.